Hi everyone, and welcome to the Tipper Analytics monthly update for October 2023. I'm putting this presentation together for my family and friends, my hive mind peers in the Visionaries Club community, and our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. My aim today is to provide some insight into the framework and strategy I personally use to trade my current Bitcoin position by talking through my logic and reasoning, showing the updated data and analysis tools I'm referencing, and providing the real-time conclusions I've come to. I always welcome feedback and discussion, so to follow me on X at Tipper Analytics to stay up to date, or that's where you can reach out. Before we begin this analysis, just a quick reminder that everything I say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives or situations, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, with that out of the way, let's start off by really this big picture view that I like to start with, which is the framework I'm using that guides my analysis and financial decision making. A lot of it revolves around the work of Michael Howell from Cross Border Capital and how he defines this concept of global liquidity. The reason I rely so heavily on the work of Howell and Cross Border Capital is because they meticulously gather data on all the components that make up global liquidity each month, much more comprehensively than any other source I've been able to access. I find most alternative sources of global liquidity to be poor substitutes because they either only focus on a small subset of countries and economies from around the world, or they focus on a small subset of important components, with many only discussing central bank money, which is that this black sort of box down here. And as you can see, that's a very small component of the total that actually makes up global liquidity. By not using data that is truly reflective of the entire world economy and all those relevant components, many analysts miss out on a significant part of the whole picture and can end up drawing the wrong conclusions. Global liquidity in most simple terms can be thought of as how much money there is in the system. It can exist and be represented in different ways, which is where it becomes complex. But the big picture view is that the total liquidity continues to head up over time as world governments create more fiat currency in various forms. Governments have no real choice at this stage as debt burdens continue to grow and need financing. So if we look at this chart, which goes back here to 1980, you can see there's a very clear, undeniable trend up and to the right. We do go through these periods from time to time where effectively global governments, global reserve banks attempt to extract money from the system, but that doesn't last very long and we end up having to push more liquidity in as the debt continues to need refinancing. We've been through one of those periods recently, and again we're back up to where we started with all logical paths leading to much higher from here. So even though that broader trend for liquidity will always remain increasing over time, there are predictable cycles within the creation of all this new currency that are quite consistent. So governments go through periods of slowing down the production of new liquidity and speeding it up, attempting to smooth out their booms and busts in their individual economies. And that's what you can see in this chart. So the black line represents what's really going on, where we've got sort of increased liquidity where they would have been trying to smooth out busts, and decrease liquidity where they're trying to sort of pull back after a boom. And you've seen this very consistently, this up and down pattern, and it really can be reflected by this sine wave that very consistently is occurring every 5 to 6 years. So we can see that with that wave over top, it has been quite consistent and arguably has become even more consistent in recent times as global debt has gotten so far out of control really that it's forced this cycle to be even more exaggerated than it has in the past. So we actually believe that it's highly likely that this continues as it has been, but probably even more pronounced, like this last cycle we've been through, over the next several cycles. So during these narrower liquidity cycles that we were just talking about, periods where the liquidity is rapidly reduced can create crisis, and periods where the liquidity is rapidly expanded create speculative bubbles. We care about this because if we can move to the sidelines near the peak of the bubble and stay there during the downturns, then enter the market again near the crisis troughs, we can significantly outperform simply buying and holding assets. Even though most assets were going to go up anyway over the long term, by being out at the right time, we can accumulate more of them at the bottom, as opposed to buying and holding where you have a fixed amount that you retain indefinitely. So you can see this is what the chart really looks like starting from 1990 here. but that's it could go back much further, but that's really so we can see some of these key events that have happened. And sure enough, at each of these lows in the liquidity cycle, you see some form of crisis. So most recently, earlier this year, the US regional bank crisis that we went through, and at the tops is where you have those asset prices really booming, and we've seen that consistently over a long period of time. So there's a lot of evidence to support this idea that liquidity is driving these asset price booms and banking crisis in the peaks and the troughs. We now move on to this heat map, which is one of my favourite charts to show, which really highlights the cycle in motion and what it looks like in reality. So the area of green dominance shows the period of rapid expansion, while the area of red dominance shows a period of rapid contraction. And as you can see over here, this was when we were fully in QE. Money was pumping into the system, or coming out of that period. Then we went into this quantitative tightening period, and where we've got this red blob in the middle, and you can see that we are now coming out of that. So it has got a bit of a tail here in some of these markets, and these are all the different countries listed down on the left-hand side here. So there are a tail of still red conditions in some of them. However, overall, we're starting to see more green pop through, and that would be consistent with what we just saw before on that picture of where we are in the cycle. So coming out of the lows is this is what we would expect, and as we start to move up, we would expect more of this to turn green. So over the months ahead, we should end up in a dark green sort of scenario like we see to the left. So some assets are better than others at more accurately reflecting what we've just gone through, this idea of the global liquidity cycle. Even though most assets go up over time in dollar terms as more total liquidity is added to the system, gold and Bitcoin act as monetary inflation hedges, which means they are among the best assets to specifically trade to take optimal advantage of the cycle. So we start the process of identifying how we're actually going to invest in this, or what the investable opportunity is, by looking more closely at gold. So this chart here, with the latest data added, shows us really quite clearly a correlation between the price of gold, and this yellow line is the price of gold, the average price for the month. So what I do is I just take the average price. It would have had candles moving up and down to make it really clear this was the average price of where we were over the last month. So as we look at this for the data that came in for September, we can see gold has sort of been somewhat flat from the little peak it had made earlier, but that's probably less relevant at this stage. What we're more interested in is that it identified the lows. And sure enough, it did right here. We had that low in the cycle right here at the low in the liquidity cycle back in October of last year. And that was the same situation that we witnessed back here. We're starting to come off to the left of the chart now, but during the low of the last liquidity cycle was also the low in the gold price. So that gives us the starting point. It's always going to be a bit choppy and messy as it is through here, as it's finding its high, but we've got consistency in identifying the low in the cycle and that lining up with the price. I've highlighted this before and I'll highlight it again. Gold in this particular case was a little bit tricky because where it should have been coming down, this was the start of the Ukraine war. So as we saw that happening, gold spiked up really when at a time where liquidity was being drained from the system. And what that did meant ultimately that when that had sort of peaked, it then resumed its downward trajectory following liquidity. So we had a little bit of an anomaly here where it spiked up on other reasons, but ended up having to follow the trend down. And we will witness this month, we've had a spike. Obviously, that's not captured in the last month's data, but we've had a spike again with Middle Eastern war tensions that have pushed the price of gold up. So that would be consistent as well. People will attribute that to things like the war, and that certainly can be the case in the short term. But longer term, we would expect that to continue because the underlying liquidity picture is supportive. It's a very similar story with Bitcoin, but Bitcoin's actually the preferred way to trade the liquidity cycle because of its volatility while it remains a young asset that's still being widely adopted. And we've seen some of that volatility just in the last 24 hours, which I'll talk about shortly. But the volatility is really a feature and not a bug when you're trading this way, as the extremes allow for much bigger gains in both directions over the course of the cycle. In this particular analysis that's on the screen at the moment, it's showing global liquidity and Bitcoin, and it was completed by Raoul Pal. And he gets a correlation here of 86%, which is very strong and significant. It becomes even more compelling when you realize that the correlation would be much higher if it wasn't for the exponential upside spikes based on where we are in Bitcoin's adoption curve. With that background in mind, we apply the framework to Bitcoin to identify the investable opportunity that we're ultimately going to take advantage of. As you can see in the Bitcoin chart, very similar to the gold chart, we had the lows in the global liquidity cycle line up beautifully with the lows in the Bitcoin price. Again, the Bitcoin price here, this blue line, is the average price for the month to make it much clearer and more simple. There's big movements when you look at the individual candles. This is the average price. So didn't line up perfectly, but pretty close. Slightly after the low in the global liquidity cycle, we saw that low in Bitcoin and was the same back on the last cycle. Now, what's really helpful for us here is that even though it looked like the cycle peaked after, which it did, like the cycle had, not the cycle had peaked, sorry, the Bitcoin price had peaked after the cycle had peaked. So when the cycle had peaked back here, Bitcoin actually was peaking around there, except it got an extra boost from what happened with all that stimulus spending out of COVID. And that was not dissimilar to what we saw with that pump due to the Ukraine war that I was just talking about with gold. So even though this bump sort of pushed it further than it otherwise would have gone, it still followed generally what was happening with liquidity. And more importantly, since liquidity had peaked and when it was heading down, even though we got this second spike, we got the spike up, we got the second spike up with all that extra stimulus spending, it still clearly identified that the risk was to the downside because as we saw and as happened, as that liquidity continued to be drawn out of the system, it was going to create a lot of headwinds for Bitcoin price, which pulled down. So it gave us some certainty, even though there can be bounces around it. It gave us certainty that the time to get in was at those lows and the time to get out was after the peak had occurred in the global liquidity cycle. And even if you had gotten in here and gotten out there, I think it was still 3 to 4 times gain that you'd made even on that before we saw this additional pump. So the system consistently worked even with these strange anomalies that can happen from time to time with extremes in the market. So we now move from the framework. So everything we've seen sort of so far is the framework, which has established why we're looking to trade Bitcoin, to the strategy, which outlines the specifics of when we will execute the trades. So the strategy is written out here. We use that latest data and trend analysis that we've done, the global macroeconomic analysis, basically just to determine where we are in the global liquidity cycle. We're doing that entirely to build up conviction, so that when we've built conviction that the lower the cycle is in, then we look for a buy signal to enter upon. The same at the top. We're looking for that conviction that the high of the cycle is in, so that we can then look to sell and move out of the position at that liquidity high. So the Bitcoin buy and sell signals specifically are only used to fine-tune our entries and exits at the optimal times as identified by that strategy. So the 60-day cycles are overlaid, which is the work that Bob Lucas does, to help manage our psychology and expectations around the likely timing of significant short-term highs and lows at the daily level. But really all of that is just sitting in the background to help us keep track of what's going on and to build or maintain that conviction that we can hold the position through the choppiness that occurs. As I said before, the volatility in Bitcoin is a feature and not a bug. So looking at this chart, I'll just go through a few key parts. So first of all, we've got the global liquidity cycle low in October of last year. So you can see that on the chart. These are the Bob Lucas markings, the cycles, and we had a cycle low occur after that liquidity was in. Then we got our buy signal not too long in, which was this beautiful setup where we'd had a cycle already gone through and it was the start of a new cycle. It was everything lined up really nicely. So we had strong conviction. We were happy to go all in on the position at that point with Bitcoin because we were confident in the where we were in the liquidity cycle, but also where we were with our other indicators over the top, just to help us build that and maintain that conviction. Now, if you look over here, it's been an absolute mess this last 60-day cycle. So you can see just today, in fact, there's a buy signal. There's been buys and sell signals all over the place. We're not entirely sure that actually was the 41-day high. We're waiting for Bob Lucas to confirm whether that was the case or not in how he looks at the cycles. But either way, we're late into the cycle. We're either late in the cycle or very early into a new cycle with this move up that we saw in the last 24 hours. So we're looking for another start of a new 60-day cycle sometime around here, which is encouraging from our perspective of how we're looking at it to keep us in the right sort of mental frame around it. But this really doesn't highlight that. More what it highlights for this cycle is that when you go through this choppy period, we could ignore all of that. So we didn't need to be paying any attention to these buy and sell signals, which could really chop people up and chop them out of the market, because the only buy signal that mattered was this buy signal back here that came off the low of the global liquidity cycle. So we're nowhere near the high of the global liquidity cycle, so we can ignore all of this noise. But we still like to watch along, obviously, because it maintains our focus and keeps our conviction high that we can ride this through the top. But at the moment, I would say, looking at that and where we are right now, very encouraging into the rest of the year and certainly into next year, that we're well and truly happy to have bought where we did and hold where we are, because the cycles still continue to support this idea that higher prices are ahead. So it's probably important also to look at the historical performance. Very hard when you've only got one data point to really map out historical performance on this specifically, but these are real trades, and I will follow along as we go so that we get a bit of an idea of what's been going on. So the Bitcoin buy was actually at 17,179. It's been 280 days since then, and that means a gain of 66%. So that's a spectacular gain as of today's candle open. So that was the price there. And if you annualize that out, that's 86.1%. So absolutely performing much better than many other strategies by simply buying and holding so far. So we'll see how that performs over time. So that's the updated application of my broader framework and specific strategy and action for this month, showing the logic and reasoning behind my current active position. The last thing I like to do, and the last set of data and analysis tools I take into consideration, they're too narrowly focused to be used to draw the main tradable conclusions from, but they do assist in building conviction. And as I've been saying over and over, conviction is really important because that's what keeps us in the trade. So they help me to build conviction on the current stage of the global liquidity cycle, but also what to expect next in markets more generally. The additional data and analysis tools look at the US specifically. So it's not doing what we were doing initially, where we're looking at the whole world, looking in at the US, but it's just because that's the clearest data that we can look at that really has the widest ranging impacts. So what I'll review now is the current trends in the consumer price inflation and government debt linked to the bond yields, as I believe those are two things that are really important to look at. So starting off with the inflation picture, this is one that I think is really going to catch people off guard. First of all, we need to understand the difference between consumer price inflation, which is what we're looking at here, and asset price inflation. So the main argument we make with the global liquidity cycle is that is going to push higher the price of gold and Bitcoin because they are assets, and they're going to experience inflation as the currency is debased and more liquidity is added into the system. So that can happen even against a background of lower consumer price inflation. Arguably, it can actually happen better against the background of lower consumer price inflation, because it means all the asset price, or all of the inflation is heading towards assets, financial assets in particular, rather than really hurting people in their hip pocket with their day-to-day spending. And I really, just analysing this chart, don't think people are on the right side of this currently. There's a lot of analysis out there that is calling for higher for longer rates based on sticky inflation. And this chart does not show that. Recently, as in very recently, we were thinking, oh, maybe this was ticking up again, and then it's pulled right back. And this is the latest data available to today. So we're sitting down at this sort of 2.3% rate, the official rate 3.7. There's a big gap there. And I would still be expecting those prints, the government official rates, to be coming in surprising to the downside, because this trueflation data, I find, tends to be much more timely and much more accurate when predicting the trend. So at the moment, consumer price inflation isn't the issue, and until we see some significant tick up on this chart, which the attempt to do there was as pulled right back, then I think it's a difficult argument to make that the inflation is remaining sticky, because the data is simply not showing that. So moving on from there, I like to specifically look at these rates, and I've talked about this before, and I'll just give an overview again. We've got this white line, which is US government debt, and it continues to rise, and it's going to continue to rise even more aggressively over the months ahead as more debt needs to be issued. The unrest in the Middle East does not help the situation either, as that will be more spending. They will probably just be approved almost universally by both sides of the US government. So you will have more money that needs to be generated, more liquidity coming into the system through that debt, which creates issues, as we've seen with these rates spiking. So as you look at this chart here, what I'm particularly interested in is that we quite possibly have seen the top here, or the stabilization in rates. There's argument that there may be one more, but it really is quite stable. But we've had this aggressive move up in the rates of all the different duration bonds. So you can see them all listed down the side there, from the 2-year right up to the 30-year bond rates. Now, those rates, for those who don't really understand how bonds work, are inversely related to the price of the bonds. So the bond prices have been falling. No one has been wanting to buy them at scale, while the rates for those bonds have been rising. So it's a supply and demand situation. Kind of makes sense if you think of it like that. As the rates rise, it becomes more attractive for people to buy those bonds because they can earn a higher yield on their purchase. So we've seen that happening. The real concern about what comes next, if we're looking at this analysis to determine what comes next, is that if these rates spike much higher than where they are now, because with this huge amount of debt, they really can't afford to spike much higher without the either government or central bank needing to step in, most likely the central bank needing to step in and implement some form of buying the bonds themselves. And that would be really just to cap them, because they can't have rates just spiraling off, continuing higher without creating real problems for the economy. So my argument has been for a little while that this is kind of a win-win for us in terms of our Bitcoin trade, because if they do spike higher from here, which is possible, particularly if there's uncertainty in the world continues to escalate and we see it really get a little bit out of control, whether that's geopolitical or just in the markets generally. If these spike higher, I think that will force the intervention, which will see more liquidity come flooding back into the market. But the other option is that these actually roll over from here and start to move down in a more orderly way themselves in anticipation of the Federal Reserve lowering rates. Now, I'm starting to think that possibility is actually there, and that is also very positive for our Bitcoin trade, because that also leads to more liquidity flooding into the market. But if you want to look at that a little bit closer, I'll just move to the next slide, which is the same thing, just zoomed in on the daily level. So that was out the weekly levels. This is zoomed in a little bit. And what you can see is really these rates are starting to show some potential signs of topping. Very difficult to pick. They're very choppy, as you can see. Like, you could have called that here as well and said, oh, they look like they're topping as they come down. It continued up. However, the difference this time is that I don't believe that there's really much more potential for these US rates to go higher, particularly on the backdrop of that slide we saw before of the consumer price inflation, because that was the main argument for the rates going higher. As we saw, there's not really an argument to be made there that inflation is problematic at the moment. It seems to be under control. That's a little bit counterintuitive for a lot of people. They know they're still feeling it in their hip pocket, but if you look at that data, it does look like it's not rapidly accelerating. So there's not really the argument that these rates are going to continue any higher. And anticipating them going lower means the bond market as well will start to anticipate that these yields are going to fall. Possibly we've seen that top in the last few days starting to emerge. So something to be on the lookout for there, but that would be quite positive as well. So I do see both scenarios as being quite positive. This one possibly being the more bullish case, because I think you would see the stock market and all risk markets really take off in this environment where rates started to fall, because that's almost the Goldilocks scenario they would refer to it as, where it's all just coming down on its own, painting a really lovely picture that it's all going to be okay. The other scenario where it really breaks off to the upside could see a lot of dislocation and might not be great for our trade in the short term, but longer term, we know the outcome of that will be more stimulus and more intervention. So it also is a positive scenario longer term, but this scenario that's on the screen at the moment where that could potentially be rolling over, I would say is probably more positive in the short term and will probably catch a lot of people off guard who are really expecting much higher from here. Okay, so my final thoughts sort of to wrap this up today, I've just put up on the screen the famous Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful. And it's something that's really important because most people tend to think that they're contrarian and tend to think that they're doing the opposite of everyone else when in fact they aren't. And I'd just like to highlight that here. So this chart, the Fear and Greed Index, is referring to the US stock market, and it was last updated on Friday, just before we went into a very uncertain weekend with Middle Eastern conflict, for example. Now, fear level was quite high, and sort of people were really predicting quite negative outcomes. That is to be expected. But when you look at it against the backdrop of all of that evidence presented about where we are in the global liquidity cycle and why the potential really is for much higher prices as we move further into that global liquidity cycle, this is the sort of situation where you want to be taking Warren Buffett's words as advice that can really help. So I think people who are waiting, particularly with a Bitcoin trade, people who are still waiting for that lower low on the basis of this fear trade really need to be careful here, because that is, you are not on the side of being the contrarian. You're actually on the side of consensus. And that's clearly what we can see when you're looking at what the market is saying. You've got a lot of people in the market who are very fearful about what could happen, and that is where you can get caught out when markets tend to climb this wall of worry where everything is negative, it couldn't possibly get any worse, and that ends up being the optimal time to buy. So I just want to sort of leave on that thought, because against the backdrop of everything else I've said there, it gives you a little bit more context around why I actually am taking these words to heart here and being greedy at this stage of the cycle. If we were right at the top of the cycle, it would be a different story. But where we are in the cycle and having this contrarian sort of fear factor lining up, it really does work in our favor, and it really does pay to be watching that and understanding that you're not on the contrarian side if you are taking the risk-averse approach at this particular juncture. So that's it for this month. Thank you for watching, everyone. Hopefully you find it valuable for me to step through the process that I go through with me in this format. I think it can be helpful to see it on the screen and me to step it through. And I certainly get value from it myself, because it forces me to really focus in on what I'm saying and what I'm thinking to really come to some conclusions. So it works for me, and hopefully it works for everyone else as well. As I mentioned at the start, I always welcome feedback on this stuff and discussion. So follow me on X at Tipper Analytics to stay up to date or to reach out. I'll be back in November with the next monthly update to reassess and identify everything that's changed. Until then, I'll talk to you on X, Discord, or the Real Vision platform. And good luck in the market until we chat again.